Well, earnings season is always critical for company valuations, for directionality of the stock market. We just pretty much got through the bulk of 2024 earnings. We've got a whole fiscal year of 2024 behind us now, and those guidance projections for 2025 are coming forward. So I really want to dig through some of the key themes that we've seen from that today and talk about, where we are as far as what we saw during those 2024 earnings reports.
Yeah, no, it's been a really good earnings season so far, and like you said, future estimates are there. It still looks like we have a strong economy, going to continue that going forward. And I think one of the themes for the year for 2025 is really going to be that continued earnings growth, but then maybe we pull in some of those valuations that have gone a little high. We've talked about it on prior podcasts, but those price to earnings multiples of a lot of companies, the S&P as a whole as well, are a little elevated from where they normally are. There are some good reasons, but there are other fundamental reasons that they should be a little bit lower than they are. And so I think we can have a really good year of growth, of price appreciation, while having a little bit of deflation in the PE multiples.
Right. And guidance expectations and analyst expectations for S&P 500 earnings growth is in the double-digit range for 2025. So that means that you could still have a bringing in of those valuations and still having that price appreciation if you see that projected earnings growth kind of come to fruition over the course of the year. So I think that's a positive. Now, I kind of want to go through some of the sectors, go through themes as far as what we're seeing, what it's telling us about the broader economy. And I think we have to start off with the big banks and financial institutions. They're always on the very front edge of every earnings season. And what we saw this year, this quarter, was really good results. I mean, we saw JP Morgan, Goldman, Morgan Stanley, Citigroup all perform extremely well. And a lot of that being, your kind of asset management. But what I think is important about the health of financial institutions and their earnings is that those big banks really provide the foundation for financial markets, for the economy. Like I said, they're on the front edge of earnings season. So starting off earnings season with some good reports is always a positive indicator and kind of helps market sentiment as you go along. And what we saw were some pretty good reports from those companies.
And so you touched on the asset management arm of these financial institutions. And, coming off of really good market years in 2023, 2024, that's, obviously going to be a big tailwind to asset management firms, whether they outperformed, underperformed, brought in a lot of assets or not. But it was really good reports on that front. You have M&A, IPO activity, kind of your traditional investment banking.
Remind our listeners what those acronyms stand for.
Yeah. So M&A is mergers and acquisitions. IPOs are initial public offerings when a company goes public for the first time, gets listed on a stock exchange. Thanks for catching me on that. So those are traditional like investment banking roles. And that broader investment banking activity has kind of been suppressed over recent years. There are various reasons for that. Part of it was just the economics of the time coming out of COVID. There weren't a lot of companies that were ready to IPO or do big transactions. Everyone's kind of finding their footing again, kind of rolling into an FTC, the commission that, approves or kind of denies a lot of these on grounds of monopolies, bad for the consumer, et cetera. That, government organization not allowing a lot of these things through. We've talked about this on prior episodes. You have some luxury handbag makers can't merge because that'd be bad for the consumer. A lot of stuff like that going on. So while that activity has been suppressed over the past few years, we're really expecting that to pick up with just the current economy and kind of a lot of demand for those activities that's kind of been put on the back burner over the past few years.
Right. So you've got that combination of already pretty good earnings, a lot doing to the trading asset management groups, but on the horizon, more investment banking activity. I think the typical loan business for those big banks too, because part of the headwind for bank returns has been interest rates being higher and the yield curve being extremely flat. A lot of times people will gauge profitability by big banks, at least on their loan book, as the spread between the 2-year and 10-year treasury. And that's just extremely slim right now. So if you get a more normalized yield curve, you'll have what's called those banks' net interest income, or NII. A lot of analysts like to quote that as far as directionality of bank earnings. I think we'll see that improve. So you'll get a combination of, if you have lower rates across the board and a more normal yield curve, you'll get the combination of more investment banking activity. You'll also get better NII, net interest income returns. And I think as far as the broader kind of macro theme that we got from a lot of these financials, it was that the consumer is relatively healthy. Spending trends kind of are keeping up, because what we saw from big banks that issue credit cards, also a lot of the credit card companies, is that consumers continue to spend. Things looked healthy in the fourth quarter of last year, and on a forward guidance basis also looks pretty healthy. But I know that we heard from some consumer companies as well when it comes to that.
Yeah, and so people look at, predominantly you have your big sellers, Walmart, Amazon, as well as it's very common to look at Home Depot and Lowe's to kind of look at that very discretionary stuff. I mean, people are buying staples and discretionary items from Walmart and Amazon, but really looking at, people doing home renovations, additions to their homes, that's very discretionary spending. So Home Depot and Lowe's are really good indicators of kind of how that's going. And like you said, they've performed well. They've had good earnings, but we have seen kind of some uncertainty with them, a little slipping of the confidence of future quarters, not really tied to any particular like economic reality, just kind of broad consumer uncertainty. We saw it recently in some consumer sentiment polls, is that, people feel good right now and everything's going well right now. But I think, maybe it's coming off of the last couple of years of really good market returns, good economy, or, facing a more uncertain world with, just geopolitics as they stand. There's a lot of uncertainty out there. So we've seen a lot of those consumer oriented companies kind of give conservative, very safe guidance going forwards.
Right. And you mentioned home improvement. I think it's interesting in that space that those companies did pretty well. I mean, expectations were fairly muted. So anything above that was what would be considered a good report. But what we kind of shown through in that is that consumers are not spending on your big ticket items. They're not, buying large appliances. They're not doing huge major renovations, but, small stuff around the house that is leading to better earnings for a Home Depot or a Lowe's. But to your point, on a forward guidance basis, it was a little bit softer. And I think that's just a trend of this broader geopolitical risk, some of that being tariffs. I think what you're seeing, consumers are just a little bit skeptical of what their situation is going to look like. And as I mentioned, I think tariffs are part of that.
Yeah. And so I was kind of bearing the punchline earlier, kind of beating around the bush of tariffs. That's a lot of the uncertainty that people are worried about going forwards, especially companies that don't know if their supply chains are going to remain intact, what that really looks like for the imports that they sell here domestically, if that's going to increase their costs a whole lot, or if it's just gonna be a bunch of talk going forwards. Like we said earlier, nothing really material has been enacted as of recording, at least. It's we have 10% tariffs on China, but nothing has really been enacted across the board in Europe. And so it's been a lot of talk, and I think that's where a lot of uncertainty comes from, while still allowing the current economic realities to be, remain pretty strong.
Right. And I think something that I thought was interesting when looking at some of those consumer company reports is people like Walmart, Home Depot were really mentioning that tariffs are something, and we have to think about this because they've really been around since the first Trump administration. We did a whole podcast really talking about the dynamics of tariffs, but they've been dealing with this for quite some time. I mean, it's not a new subject to them. So supply chains are always shifting. They've been working through this over the last, call it 8 years plus. And so they've grown accustomed to dealing with this situation. I mean, nobody really stood out to me on earnings calls saying, oh, yeah, this is a huge issue. We're really worried about it. Of course, part of their job as management is to make people feel good about the company. But most of the questions analysts ask about tariffs, management teams really kind of shrugged those off and weren't really too concerned about it. Now, one final piece of the consumer that I want to talk about is travel spending. So we always see the cruise lines report, airlines, companies like booking.com that are kind of, facilitate all of that. And what I thought was a positive indicator was the health of travel spending. It continues to be high. Of course, we're kind of past that initial, post-COVID revenge travel theme where everyone was trying to get out because they hadn't been able to for a couple of years. So things have normalized more, but travel spending remains high. And I think travel spending is always a good indicator of consumer health because it really shows you that consumers are still willing to spend on travel. And that's one of the first budget items that gets cut when consumers feel pinched, because you're not going to take your international trip or even your trip across the United States if you're struggling to put food on the table. Or you're struggling to buy the things you need to on a day-to-day basis. And so the fact that, especially on the low end, kind of like budget airlines or even cruise ships showed pretty good results, which means that kind of low end consumer that would get pinched under adverse economic situations continues to be pretty healthy. So I think as far as a trend and a theme for the consumer and kind of macro commentary, it looks good right there.
Yeah, it does. And, that's a great thing to keep an eye on. You mentioned bookings, that's another one of those big consumer items. And so it's good to still see a strong consumer now, even though, future uncertainty, we'll see how this pans out. But all of that really leads us into the big dog of earnings season, what everyone's kind of waiting for with Nvidia most recently, but also just like your hyperscalers, your Amazon, Google, Microsoft, et cetera, is, post DeepSeek, which, we've talked about that before on podcasts too. I'm sure people have heard all about the Chinese large language model that kind of, came out of nowhere essentially, and took the media headlines by storm, created a lot of uncertainty around future US spending on AI because they were supposedly able to do it for a lot less than you see these hyperscalers putting into it. But what we saw with all of those hyperscalers, like I mentioned, your Amazons, Microsofts, they all reiterated really high CapEx spend going forwards. And that's CapEx spend on data centers, on NVIDIA GPUs, on AI as a whole. And so that really helped add a lot more confidence back into this, the theme of AI, of that kind of trade that's been so pervasive over the last year plus now. And then most recently, NVIDIA, still really good results. Their Blackwell latest chip has finally ramped full production. And so they're feeling really good about the industry as well. Victor, I want you to talk to us a little bit about kind of NVIDIA's thought process. Does it all revolve around these large language models? Is there more to it? What do they see going forward for the industry?
Yeah, that's an excellent question, because I think as consumers, we think about the applications that we use when it relates to AI, and that's your ChatGPT, your large language models. You ask it a question or ask it to give you some kind of itinerary or help you write an email, and it spits you back an answer. Well, there are a lot more applications than that when it comes to robotics, when it comes to autonomous agents. Autonomous agents are essentially, if you think about, call support center, if you need help with XYZ company you're dealing with, or you need, an agent to kind of work as an employee and essentially solve problems, throughout your business. Autonomous vehicles with optical kind of video recognition and processing all that data. There are just so many more, what I would just put into the bucket of commercial applications rather than your really consumer focused applications that are really where the true need for data processing and computing power really rely. Because the LLMs, the large language models, they require massive data processing, but once those are functioning to a degree that's, deemed very satisfactory for the consumer, then yeah, you're kind of tapped out there to some extent. But I think even those, what you're seeing is what's really interesting is you're seeing a shift to these models becoming more reasoning models. We heard Jensen Huang talk about this, where the model's not just spitting back to an answer as fast as possible just to give you something on paper that's kind of maybe more or less answering your question, but it's going to actually like think like a human and go through a process of reasoning. Hey, I'm not going to just give you the answer that you're asking for. I'm actually going to think about, maybe why you're asking the question, what you really want to know, and what's actually going to be helpful for you. So the model is going to think through and use reasoning in order to provide a response that's not just a quick answer like a Google search would be, but to actually create some value. And that requires much more compute than these, the large language models of today.
Yeah. And I thought that was super interesting, from hearing from Jensen on that subject of whenever he saw DeepSeek, well, when the market saw DeepSeek, they sold off all of these big companies. There's a lot of panic in the markets about that. When Jensen saw DeepSeek, he saw the proliferation of those reasoning models where it goes from, everyone concerned about training is the expensive part to now inference, as he quoted it, using a reasoning model, which does produce much better results. Like it is worth it, but it costs about 100 times more in terms of compute than the previous models that just spat back a Google search, here's your answer immediately with no real thought process to it. And so 100 times more data going into these answers, which really adds a lot of value to people, but does continue the need for more and more data centers, even after a lot of these models have kind of been trained. I mean, there's always going to be training going on, but everyone kind of was expecting the shift to inference, where it's a lot less compute intensive. It was kind of more run rate situation where all that CapEx could be brought in a whole bunch. This is just another example of, we have more power, we're going to find something to do with it. I think an analogy that's like really fitting is when computers first came out. I know talking to Frank at Bet Capital Management, he'll tell you about buying, paying up, hundreds and hundreds of dollars at a time to get another megabyte of storage. And everyone was asking him, what are you going to do with 2 megabytes of storage on your computer? Well, as the technology gets more and more advanced, people find new things that they're able to unlock with all of this. So I don't think it's unreasonable to expect as these data centers get built out, as we have more compute at our fingertips, people find new and novel and exciting ways to apply that, thus driving the demand for more and more of it.
Definitely. And I think that kind of gets to the heart of why, and we're talking about Nvidia because of how important that earnings report is for the entire market. Options markets were predicting huge shifts in the whole S&P 500 and NASDAQ based off of Nvidia's earnings release. And that's just because it has so many implications for so many other businesses. It tells you, hey, are the hyperscalers, your Meta, Microsoft, Amazon, Google, Oracle, are they actually spending as much as they say they are? And is that being attributed to Nvidia? Because at the end of the day, Nvidia is heavily reliant on them. But then it's also giving you signals about, hey, what is the outlook for energy demand? Because these data centers are such big consumers of electricity. Oh, what's the implications for server rack companies? What are the implications for the chips that are run in tangent to the Nvidia GPUs? It really has implications for the broader space. And it also shines through and says, hey, do these big software companies, a Meta, a Google, an Amazon, do they see the value in this AI infrastructure? And I think at least for this most recent quarter and the guidance that Nvidia issued says, hey, yes, it's still valuable to invest in these GPUs and more computing power.
Yeah, I think that kind of goes back to, we did a podcast talking about kind of that whole value chain. And what's sitting at the top of it is Nvidia, and so that's why, to your point, the trickle down of the implication it has on the entire, not even industry, just broader markets is so huge. So I think that's a really important one to keep an eye on going forward, and really, really exciting stuff going on.
Definitely. Well, hopefully we gave, our audience something to think about when it comes to the most recent earnings season. I think we really hit some key themes that we heard about. And at least coming out of this earnings season, I'm feeling, pretty good about where the economy's at.
Yeah, me too. It'll be exciting to see going forward how much of this uncertainty actually translates into economic reality. So thanks, Victor.
Thanks.